Grab a notebook and pen because you're going to want to take notes. In this video, I'll guide you step by step on how to build effective trading rules and use them to execute high probability trades. Let's dive right in. Step 1. Preparing for the market. First, make sure you're in the market by 9 a.m. New York time. Start by checking the economic calendar for any news scheduled for the day. If there's a news event, avoid trading before and after the release. Wait at least 4 to 5 minutes on both sides to let the volatility settle. If there's no news, the next step is to focus on identifying key areas of liquidity in the market. This will set the foundation for finding high-quality setups. Step 2. Early market reaction. Now, while we usually prefer to wait for the 9:30 a.m. market open, sometimes the market gives us a strong reaction earlier. For example, in this case, the market reacted strongly to a big fat FVG. Let me show you how to identify and leverage such opportunities.
Before we jump into the strategy, let's take a moment to set up your trading rules. Grab your notepad and jot these down. I'll also include a link to a Google Doc in the description so you can have a ready-to-use template for your trading routine. Here are your trading rules. 1. Check the news calendar. Always start by reviewing the economic calendar for any red-flagged events. 2. Mark the 9:30 a.m. open. Highlight the NY session. Open for better context. 3. Limit your trades. You can take 1 trade per day. If you decide to take 2 trades, you must reduce your risk to 0.5% per trade. 4. Risk management. Risk a maximum of 1% per trade with a minimum risk to reward RR ratio of 2R5. Stop placement. Place your stop loss just above or below the swing point of the market structure shift. 6th, target selection. Aim for opposing liquidity levels or any clear liquidity points. Trade confirmation checklist. Now let's go over the key confirmations you'll need before entering a trade. 1. Market structure shift plus displacement. Watch for either buy-side or sell-side liquidity to be taken out. These rules will keep you disciplined and focused, helping you avoid impulsive trades. Stick to them and you'll have a strong foundation for consistent trading. Let's move on to the strategy.
Take a closer look at this setup. Notice there are 4 equal highs that the market took out but didn't close above. This indicates weak bullish momentum. Following this, the market dropped sharply in just 3 candles, while it took 17 candles to recover. This asymmetry suggests the market is hesitant to move higher towards those equal or swing highs. But here's the key. This information alone isn't enough to enter a trade. We need additional confirmation such as a market structure shift and strong displacement. Ideally, we also want to see an FVG, IFVG, or an order block forming to support our decision. Step 4. Entry execution. Some traders might place a limit order at key levels, but I prefer to wait for a reaction at the PDRA, premium discount range area, or any other point of interest. Once the reaction occurs, I look for an FVG to refine my entry. In this trade, we waited for the 9:30 a.m. reaction and then entered on a clear FVG setup. Remember, trading rules are there to protect us. For me, this means taking my take profit TP at a predefined target. Step 5. Managing the trade. If you're someone who likes holding trades for a longer move, that's totally fine. But make sure to manage your risk properly. Secure partial profits along the way and move your stop loss SL to break even to protect yourself. Following a structured approach is what makes the difference between consistent profitability and unnecessary losses. Stick to your rules, stay disciplined, and always wait for confirmation. If you found this video helpful, make sure to like, subscribe, and let me know your thoughts in the comments below. See you in the next one, and happy trading.